Hi, in this video, I'm going to show you how to calculate the depreciation on your residential rental property. Here's the example here. We're going to walk through this example. Before that, just want to know that for residential rental property, IRS rule is you have to depreciate 27.5 years. So use the straight line method and use also called the min-month convention. We'll talk about this, tell you what that means. Let's see this example. In October 2020, you bought and placed in service a residential rental property for $350,000 with a recovery period of the 27.5 year, which is this is your depreciation year. And the adjusted basis of the building is the cost $350,000. So basically, say adjusted basis is equal to the purchasing price. So then you use GDS. You don't need to worry about this. You just have to know this is a straight line method and the min-month convention to figure out your depreciation. You plan to sell the property in May 2024 for $400,000. This basically is from 2020 all the way to 2024. So this is a total 5 years from the year you bought the property to the year you sell the property. How much is the total is the depreciation. First, you want to understand. So if you use the straight line method, 27.5 years, so then you want to calculate the rate. Let's say for each year, how much you're gonna depreciate is 1 divided by 27.5. You get a 3.636%, which means each year your depreciation rate is 3.636% of the adjusted basis. Adjusted basis is equal to your purchasing price. So basically, it's 3.636% times the $350,000 give you each year the depreciation. You can see from the year second year to the year fourth year, you get the same depreciation rate. However, the first year and the year you purchased and the year you sell is a little different because you didn't have the whole year. That is, you can see here you bought in October 2020. So you have to use this rate is 0.75%. How you get the 0.75%? So basically say, well, you bought in October. We use this called min-month convention. Say in the month you bought, we only count as a half month. No matter you bought at the first day of the month or last day of the month, we always count a half month of the month you bought it. So October is half month, November is 1 month, then December is 1 month. So in the year 2020, you have 2.5 months. 2.5 months out of the year 12 months. So you get a 20%, 0.8%. Then you times this annual depreciation rate, which give you 0.758% here. So that's how you calculate the year you bought it. Then the year you sell, here you said you're gonna sell in May 2024. So in May is half month. Then in January, February, March, and April is 4 months. So it's 4.5 months out of 12 months. So this you times annual depreciation rate, which give you 1.364% for on the year you sell. So that's how you calculate the year you buy and the year to sell the depreciation. Then you add all those amounts together, which give you total depreciation is 45,591. So then you give you after you sold your property, so you have adjusted basis. So before you sell your property, you have adjusted basis is your purchasing price minus the depreciation. Then give you the adjusted basis is $304,409. So then your total gain is you have to use, let's say you want to sell is $400,000 minus your basis give you total gain is 95,591. So within the gain. So if you do not adjust the basis, you can see your purchase price and the sales price. So give you you have a 50,000 gain. So this gain is called 1231 gain. And so this gain is your long-term capital gain is taxed at this rate based on your annual income. And your gain, then the rest of the gain actually is your depreciation. You can see it's equal to your depreciation amount. So when the year you sell, you have to recapture your depreciation. So the depreciation is taxed at 25%. Anyway, so this is just the information that how you calculate the tax when you sell. So this video is to show you how do you calculate the depreciation. Then on IRS website, this on the publication 946 is how to depreciate the property. So actually they IRS give you a table. How to use this table is, let's see, you for in our example we bought the property. This basically show you how to when you bought the property, you bought the property in the October. So then you get the rate of the year you buy is 0.758%. So then you can see here is 0.75% in the year you buy. Then you times your purchasing price, that's give you the depreciation. So basically this is year, they say year 1, then year 2 to 9 is reduced 3.63. So 3.636%. So exactly is equal to our rate. This one is coming from 1 divided by 27.5. So you if you don't want to calculate yourself the rate, you can use this table. You can simply say I bought in October. Then the first year rate is 0.75%. The second year to 9 is 3.63%. So that's how you use the table from IRS website.